This is Chapter 4, and it's all about income tax withholding. And remember, Chapter 3 was about FICA taxes. Income tax is something different, and the employers withhold it. And if you're self-employed, then you have to pay these in quarterly, because the IRS wants their money throughout the year, not at the end of the year. So we will proceed to learning objective 1. Coverage under federal withholding, federal income tax withholding laws. I'm just going to call it FIT. Okay? There has to be an employee-employer relationship so that before the FIT withholding laws apply. Chapter 3, we talked about what's an employee, what's an employer. So if there's that relationship, if you have an employee and employer, then you've got some obligation to withhold income tax. Statutory non-employees, like direct sellers, qualified real estate agents, they don't have any federal taxes withheld. They have to pay those themselves quarterly. So when we're looking at the taxable wages for federal withholding purposes, what we're saying is these are the wages that are used to determine the amount that should be withheld. So the gross amount of the following items are taxable: wages and salaries, vacation pay, supplemental payments, bonuses and commissions, taxable fringe benefits, we'll talk about that in a minute, tips, cash awards, and then there's some additional types of payments that are listed in Figure 4.1. Next one. So let's look at the fringe benefits, what's included there. Any non-cash fringe benefits that are treated as compensation, and we had looked at that in the last chapter, what's considered compensation. For these, the employer has to withhold federal tax unless specifically excluded. Some examples would be tickets to athletic events, athletic club memberships, personal use of car. Sometimes they'll give you their frequent flyer miles, stock options when the options are exercised. And again, there's a really complete list in Figure 4.2 that I'm not going to go into, but you can look at that. It's in your textbook. So all of these are included as gross wages when calculating the federal income tax. So the excluded fringe benefits would be qualified employee discounts, because it's not like you really get anything, it's just like you have to pay less. Reduced tuition, meals, and lodging if it's for the employer benefit. The de minimis fringe benefits, basically de minimis means it's immaterial, it's not worth tracking. So, your cell phone that is bought or paid for by your company, they're not going to try to figure out what your personal usage is of that and charge you for that. There's a complete list found on page 4.4 of the text, or you can consult the Circular E, and this is a good time to bring this up because you're using a textbook, but this textbook is going to be out of date within a year, some things in it. So Circular E is what the IRS publishes, and it's updated every single year. And it's the employer's tax guide. It's the Bible for employers. And if you're working in the area of payroll, you certainly want to have a Circular E, and they're free. You can get them from the IRS. So, how do you withhold federal income tax on fringe benefits? First, you have to value the fringe benefits no later than January 31st. And you're going to treat them like supplemental wages, and you're going to withhold a flat 25%. So on that one, you just treat it by itself. You're not combining it with other wages. Another way is you can value it and then add it to the regular pay and treat it as one big fat paycheck and withhold accordingly. There's a flexible reporting option. You can treat benefits as being paid on one or more dates in the same calendar year, even if the benefit is received at one time. So, for example, you can add an entire $2,000 value of country club membership. You should be so lucky to get one. Or you can add $500 on each of 4 paychecks and then calculate the withholding accordingly. This makes a difference because when we look at the brackets for calculating the federal income tax to be withheld, a $2,000 hit in one paycheck could add quite a bit more rather than $500 for 4 different paychecks. The employer can choose not to withhold federal income tax on the employee's personal use of a corporate car. So, how do we work with tips and withholding? The employee must report tips to the employer by the 10th of each month. So it would be like the tips for August would be reported by September 10th. And then the employer must withhold federal income tax and FICA based on this information. And these are called reported tips. The employer is not required to withhold on allocated tips, only reported tips. And this should sound familiar to you because these are the same rules when it comes to withholding Social Security and matching Social Security. So tip allocation can be done one of 3 methods, based on hours worked, gross receipts, or a good faith agreement. And your text talks a little bit more about that. And we talked about it in Chapter 3. If there's a big difference between reported tips and 8% of the gross sales, then the IRS sort of says basically your employees are underreporting their tips, and so we're going to allocate tips to them. So, what if the taxes withheld are greater than the hourly wages to be paid? So, for example, a blackjack dealer in South Lake Tahoe reports tips of $2,000 for a week. Now, obviously, she's a very good blackjack dealer, but her wage is probably, $213 or low, because her employer knows that she's going to make a lot of tips. So. If you look at the withholding for her $2,000 in tips, she's not even going to have enough in her gross paycheck to pay for that. So in that situation, she gets no paycheck. Basically, they'll withhold her entire paycheck and forward it, and she'll have to pay the difference in estimated tax payments. So whatever is not withheld, she'll pay an estimated tax, or she can pay the balance when she files her 1040 tax return. Traveling expenses are the reimbursements made to an employee paid under an accountable plan are not subject to federal income tax withholding. So what is an accountable plan? It's an IRS approved plan, and it has to meet 3 rules. The travel has to be connected to business, and there has to be an adequate accounting of all of the expenses incurred for the travel within a reasonable time period. You can't turn them in, like a year later. And the employee returns advanced cash in excess of substantiated expenses. A lot of times this doesn't happen because they're not receiving advanced cash. They have a corporate credit card and they just can charge it on that, or they charge it on their own credit card and then submit the receipts. That's basically what I do at the community college when I travel for the college. I pay for it, I come back, I've got my receipts, and I submit them and get reimbursed for them. And there's no federal income tax withholding because it's not income to me, it's just a reimbursement of expenses. Now, if there's not a plan in place, then the travel reimbursements are made under a non-accountable plan and they're considered wages. And therefore the employer has to withhold federal income tax. So it's worth it for the employer to get a plan in place. So what is exempt from federal income tax? The law includes certain payments, including ministers' wages and salaries. I used to do accounting for a nonprofit organization. It was Living Church Ministries, and it was my volunteer service. And the ministers in there didn't have to pay any tax. Well, nothing was withheld, let's say that. Any advances, because they'll actually get, the federal income tax will get withheld when the wages are actually paid, when the payroll actually is run. Educational assistance is exempt if it maintains or improves the job status of the employee. And you can have $5,250 per year of employer-provided assistance for undergraduate, or graduate is tax-free. This also applies to downsized employees, meaning employees that have been fired, but they're still getting educational assistance from their employer or their former employer, perhaps to help them retrain for a new job. Also, qualified moving expense reimbursements. People that are with the military, the military will move them and they get reimbursed for their expenses. That's exempt from federal income tax. And transportation in a commuter highway vehicle or transit or a transit pass up to $125 a month in value. When I first started working at the community college, they gave us free bus passes. That's not the case anymore, but the value of those were not included in our monthly, or in our wages, and they were exempt from federal income tax. There's some more exempt payments in figure 4.2 you can look at. So pre-tax salary reductions are exempt from federal income tax. Contribution to a cafeteria plan, contribution to flexible spending accounts. This is what we have at the college. I have pre-tax dollars put into an account that I can use for health care. For me, it's just health care. I don't use it for insurance premiums or dependent care. And so when I get health care that isn't covered by my medical insurance, I can submit these to my flexible spending account, the managers of that, and then they'll pay me, they'll reimburse me for that. It's basically my own money they're giving back to me, but I didn't have to pay taxes on it. However, I always have to predict what I'm going to use, because if I don't use it all up, then I forfeit it. It's like I don't even get that money. And so I don't have FICA or federal income tax withheld on those pre-tax dollars. Health savings account are also monies that the employer has set aside. And they can do this if they have a high deductible health insurance. And what we mean by high deductible is, it might be you have to pay the first $1,000 or $5,000 of any medical claim, and then the insurance will pay after that. And so you can contribute to your HSA, and that can be used to help meet your deductible. Like, you know, your first $5,000 worth of expenses. Archer Medical Savings Account is for small employers that have high deductible insurance plans, whereas the HSA is for employees. So also, contributions to tax-deferred retirement accounts are set aside from the current paycheck, and those will be paid out upon retirement. So there's 401ks, 403bs, 457bs, simple plans, all kinds of plans. Contributions are pre-tax for federal income tax. However, the employer must still withhold and match the FICA. And there's some additional makeup amounts allowed if if it's going to be contributed if you're 50 or older. If you have contributions to an IRA that your employer forwards for you, it comes out of your pocket, but they basically withhold it from your paycheck and forward it. Up to, I was going to say up to, what I meant to say was an employee can contribute whichever is less, $5,000 or 100% of their earned income. So, if they make more than $5,000, then they could do, or if they make less than $5,000, they could do 100% of that. And if these contributions to the IRA are made through payroll deductions, then the employer doesn't have to comply with ERISA. And we'll talk a little bit more about ERISA later, but those are all the rules surrounding retirement accounts. Roth IRAs are used for non-deductible contributions, which means you pay taxes, federal income tax on those. How much do we withhold for federal employment? I say federal employment, federal income tax. The best for the employee is if they gauge it right, and the federal income tax withheld is exactly what the federal tax is when they calculate it based on their 1040. So the goal is try and come out even. Some people love huge refunds. I do a lot of taxes for people, and some of them have like $3,000 and $4,000 of refunds every year. And I always say, why would you give the government use of your money all year long when you could have it? Why don't we increase your tax exemptions and have less withheld, and then you have the money during the year instead of the government? But they sort of use it as a forced savings plan because they figure if they get it throughout the year, they'll spend it, but if they have a big refund coming, then they might use it for something that they wouldn't ordinarily have been able to save for. So the employee completes a W-4 form, which tells the employer how many withholding allowances they want to claim. And one allowance is for themselves, unless they're claimed by somebody else, and then one for each dependent. And then you can get special allowances such as itemized deductions, other compensation, tax credits, etc. There's a big worksheet on the back of the W-4. And so I just want to make a point here to say that what you have withheld, the allowances, are simply a mechanism to tell the employer how much tax to withhold. And it might seem counterintuitive, but the fewer allowances that you claim, the more tax is withheld. And the employer has to have a copy of that W-4 and keep it as long as it's in effect and for 4 years thereafter. There's a specific IRS publication 919 that will address how to adjust the tax withheld so that it gets to the amount that you want it to be, which is basically no refund and no tax due when you file your return. And there's also an IRS publication to help you calculate your federal income tax withholding. So, completing a Form W-4. First, you have to choose single, married, or married, but withhold at a higher single rate box. Because when you're single, more is withheld than when you're married. You'll see this when we look at the wage bracket table. So why would an employee choose to have tax withheld as married but at the higher single rate? It may be that they have other sources of taxable income that they're not having anything withheld on, and so they want to have more taxes withheld to cover that. So for instance, I have a full-time, this is what I do basically. I teach full-time at the community college, but I also have a side business doing accounting and taxes and QuickBooks for people. And the money that I make from there, I could do quarterly payments, but instead I just have more withheld from my community college job so that it covers my income from my side job. Now, if you know you're not going to owe any income tax liability this year, and you didn't have any last year, then on your W-4 you can claim exempt. This is valid for 1 year, and it has to be reclaimed each year. You cannot claim exempt if you're dependent on someone else's tax return and you have income exceeding $950, including more than $300 of unearned income, like interest and dividends. And some individuals are automatically exempt. So I have a client, a married couple, who have 2 children. Both of them work, but they don't ever make enough money to pay taxes. They never owe taxes, and so they claim exempt, and nothing is withheld from their employers because they never owe taxes. They don't have any tax bill when all is said and done. It's never a good idea to advise an employee how many allowances to claim. Let them complete the Form W-4 themselves and turn it into you. So if an employee doesn't provide a completed W-4, the employer must withhold as if single and 0 allowances, which is the very highest rate. And oftentimes what will happen is you do that once and the employee says, hey, my gosh, you've withheld so much. And then you can say, well, you didn't give me a W-4, so I had to do it based on single and 0. The employee can change the W-4. And when an employer receives an amended W-4, they have 30 days to change, because sometimes it involves going into your computer system and making some changes. The employee must change within 10 days for a decrease in the number of allowances. So remember, when you go down, then more is withheld. If there's an increase in the number of allowances, then you can change it or just leave it. And there are also additional voluntary withholding agreements that can affect additional federal income tax by either reducing the number of withholding allowances or just flat out saying, I want this amount to be withheld. So sometimes what I'll do with clients is if they have taxes that they owe at the end of the year, I just say, okay, take the total that you owe and divide it by 24 if they're like a monthly pay period, and just tell fill it out on the W-4 to hold this an additional amount. So they don't really even change their withholding allowances, but they just have an additional amount withheld. The employer can establish an electronic W-4 system where employees will enter all their information and basically submit a W-4 electronically, but they have to provide a paper option if the employee requests it. Any unauthorized changes or additions make the W-4 invalid. The employers aren't supposed to submit the W-4s to the IRS unless the IRS asks for them. And there are penalties imposed for filing false W-4s on purpose. So you also have to have federal income tax withheld for pensions that are in excess of $19,680 per year. So people that are retired that are getting paid a pension have to have it withheld, income tax withheld if it's greater than this. And you withhold as if they're married with 3 allowances unless they complete a W-4P to change the amount of tax withholding. So this is like a Form W-4, but it's for pensions. Also, a third-party payer of sick pay. And again, there's a W-4S that you would submit to them to tell them what to withhold. How many allowances and what the marital status is. Government payments such as Social Security benefits, you can have tax withheld by completing a W-4V. And I was trying to figure out what this V stood for, and it must be voluntary. So the S is for sick, the P is for pension, and the V means it's voluntary if you want to have it withheld.